On the program today, the International Labour Organization says no recovery in global jobs market from pandemic until at least 2023. South Africa seeks additional power from private producers as country suffers continuous power outages. And global food prices surged to highest in almost a decade. Thank you for joining us on Business Incorporated. I'm Chimeze Obi Iwa. We'll get the show started now with the markets numbers. And the theme for most of the markets we track here in Africa is red, as they traded mostly negative at intraday. The JSE index in South Africa was heavily down at 1.36%, while the NGX index was down marginally. Egypt was also in the red, 0.42%. Kenya traded in the green on Wednesday. And in the Middle East, it was also mostly red except Saudi Arabia. The Abu Dhabi market was down 0.30%, while the Dubai financial market was 0.53% down. Saudi Arabia and Qatar traded sideways, while the Tadawul Stock Exchange in Saudi Arabia traded in the green 0.30%. The Qatari index was down 0.46%. In Europe, stocks were slightly lower this morning as investors reacted to fresh data out of China and looked ahead to a key U.S. jobs report later this week. Meanwhile, there are other developments catching investors' interest, and that's what Ashutosh will be talking to us about. Hello, Ashutosh. Ashutosh, good afternoon. Well, good to see you again. The U.S. announced on Wednesday 25% tariffs on imports from 6 countries that have introduced digital taxes targeting big U.S. tech firms, but it immediately suspended the tariffs on countries including the UK, India, and Italy to allow time for negotiations. What's behind Washington's move?
Hi, Chimi. Thanks a lot for having me. Yes, basically there are 2 aspects to it. One is the imposing of the tariffs and then the subsequent suspension of those tariffs. Now, why the imposition? Perhaps that's to do with the fact that Wednesday was a deadline and the statutory authority actually to impose a tariff like that would have expired, and that's the reason why it was announced on Tuesday. Now, the other reason is why the U.S. authorities want to keep that option of actually slapping tariffs going forward. They did not want that option to go away because of this deadline expiring. And that is because they want to keep the pressure on these countries. It wants to show them that it is ready to slap tariffs if they come up with unilateral measures or unilateral taxes on targeting U.S. firms. And they should actually, it will come in play again if there is no international agreement on taxation. Now, why the suspension is because the U.S. feels, and it is hopeful, that there is going to be a deal sooner than later. While we all know that OECD-led talks on global taxation, digital tax, and other international tax issues is in the home stretch. A deal is imminent. It could be as early as the second half of the year, and that's predominantly because the U.S. has come to back this idea of a common minimum corporate tax. So that is why the U.S. has suspended those tariffs for now, and it wants negotiations to take place.
Now, why has taxation turned into such heated topic in recent years?
Well, Jimmy, we've got to see that what international taxation rules are right now. I mean, basically, most international tax rules for now are all those rules which were coined many years back, and they haven't really been reformed over the past few decades. They haven't really seen any reforms there, and that's the reason why they are basically outdated. They don't really reflect the realities of modern day commerce, which is dominated by these big IT firms, the technology firms. So now governments complain that these big IT firms use some loopholes in these rules, and they actually evade taxes. They don't pay their fair shares because they are able to actually route some of their profits to these low tax jurisdictions. And that's the reason why they've been coming up with these unilateral measures to tax these companies, much to the irritation of the US, which now wants a more multilateral approach rather than unilateral taxation.
All right, away from taxation matters, data today is Eurozone services sector, and that grew at its highest pace in 3 years. That must have cheered the markets, didn't it?
It was definitely a positive sign. We've been talking about all the positives, data points the whole of this week, and this definitely adds to that list of positive data. It just shows that it is a broad-based recovery now. The services have joined the party, like we talked on Monday and Tuesday, after those employment data that came, which showed that even the services sector is now employing people. The manufacturing sector has been doing well for quite some time now. The services are doing well, so that's a positive sign that this recovery is a broad-based recovery, and perhaps this augurs well for the economy as a whole. Now, the PMI data today also showed that the employment was increasing. What that means is that, yes, the services sector is now employing people, and they're ready to actually hire people, they're ready to get into business. But what is interesting there is that the employment is not increasing at the rate of the output. The output is still more than what the employment is. Now, that is to do with the fact that because many of these services firms are for now adding working hours to the employees. Remember, they were put on short-time work, and many of the furloughed staff is coming back. So the unemployment data might not be going down, but there are people who are joining the workforce in terms of like high number of hours. So that's the other thing happening. Then the other thing that pointed to was the high pricing pressure. That's been a theme that we've been talking about this whole week. They said that now manufacturing sector has been actually transferring some of the high costs to the services sector.
All right, thank you very much for updating us on those. We still have one more day to go for the week, so hope to see you tomorrow. Enjoy the rest of the day, Ashutosh.
Thank you, Jimmy.
In the UK, the latest services sector PMI shows growth hit 24-year high. Well, let's have our intraday calls with Juliana. Hello, Juliana. Good afternoon. Well, the UK economy is enjoying eye-popping growth as services companies see a surge in demand after lockdown restrictions were eased. Where is the biggest change coming from here?
Good afternoon, Chimese. Well, it's across services, but namely, I would say retail and hospitality. As you said, eye-popping is one way to describe it, because a 24-year high is just exactly what these hospitality bosses really needed after being locked down for the best part of 1 year. The services PMI beat flash estimates, I believe, which were about 61.8. It came in at 62.4, with 50 being that benchmark number that shows the level of growth. And this is exactly what the Bank of England and the Chancellor Rishi Sunak have been speaking about, particularly in the first quarter. In the second quarter, first quarter GDP fell by about 1.9%, not as bad as it could have been. And we are now starting to see signs that this recovery that the Bank of England and the OECD spoke about earlier this week are indeed happening. So really great figures. And of course, we're still waiting to see if D-Day, June the 21st, is going to go ahead, and we'll be seeing much more of the services sector open for the public.
Well, in the morning today, the London stock market dipped. How much of those data is driving sentiment?
Not much, unfortunately. The FTSE is still very much in the red. It was in the red, as you said, at early trading, still in the red at intraday. This is despite those positive PMI numbers, but it did help lift the pound against the dollar earlier. I think, as you were discussing, lots of investor sentiment is weighed on what's going to be happening across the pond in the US. Tomorrow, we've got those all-important labour market figures. Last month, they came in disappointingly low. We're going to be looking, or we're going to be hearing probably right about now about payroll figures and, of course, the non-private payroll sector. Those are really, really important because we know investors at the moment are weighing up a really strong economy with the increase of inflation, which has also been noted in the PMI data that we received from IHS Markit earlier today. So the numbers show the all-share is up 0.03%. The FTSE 100 is up by 1.04%, and the FTSE 250 up by 0.82%. I have to check those numbers. In currencies, the British pound is down against the US dollar by 0.34%, down against the euro by 0.27%, and down against the Japanese yen by 0.22%.
Well, the former footballer David Beckham has now taken interest in electric car by buying stake in vehicle electrification firm Luna's. Obviously, the jump in petrol prices won't alarm those who have made the switch to electric cars. But what will this deal mean for Luna's?
Yeah, it's interesting. Of course, any British company that can slap the face of David Beckham on their merchandise isn't doing too badly. And anybody who is a fan of the former footballer turned model turned entrepreneur knows that he loves his fast cars. And so he has put his money, a 10% stake down in Luna's. They're a pretty new company based in Silverstone. What they do is they've jumped onto what is likely to be an extremely lucrative upscaling, upselling electrification market. So what they're doing is they're going to be taking pretty expensive cars, starting with a price tag of about £250,000 minimum. Some of these cars go up to about £500,000, and rather than environmentally conscious individuals buying a new electric car, they can transform these old models into electric vehicles. And that's exactly what the company has been doing. They haven't been doing it for that long. I believe they've been open since 2019. They've got the backing from David Beckham. We actually have a statement from David Beckham. He says, Luna's represents the very best of British ingenuity in both technology and design. I was drawn to the company through their work restoring some of the most beautiful classic cars through upcycling and electrification. David Lawrence, one of the founders, and his team of world-class engineers are building something very special, and I look forward to being part of their growth. And so, of course, as well as the expansion comes lots of new jobs for the UK, high-skilled jobs, which is definitely going to please Prime Minister Boris Johnson.
Interesting. Well, tomorrow is another day, and we will be chewing the US job data, so I look forward to that. In the meantime, enjoy the rest of the day.
Thank you, Jimmy.
And shares in Asia Pacific were mixed in today's trade as investors reacted to data releases in Australia and China. Hong Kong's Hang Seng Index led losses regionally, declining about 1.2% as of its final hour of trading. Mainland Chinese stocks finished in the trading day lower, with the Shanghai Composite slipping 0.36%, while the Shenzhen Component shared 0.65%. South Korea's Kospi closed 0.72% higher. Elsewhere in Japan, the Nikkei 225 gained 0.39%, while the Topix Index ended the trading day 0.84%. Shares in Australia also closed higher, with the S&P ASX 200 climbing 0.59%. And U.S. stock futures were lower early this morning following a quiet day of trading on Wednesday. Futures for the Dow Jones Industrial Average slipped about 50 points. S&P 500 and Nasdaq 100 futures both also traded lower. During the regular session, the 30-stock Dow rose just 25.05 points. Now, the market focused on the link between inflation pressures and the reopening of U.S. businesses may be on hold before the release of the jobs report on Friday, which is likely to show an additional 671,000 non-farm payrolls in May compared to the 266,000 jobs that were added the month before. And oil prices rose for a third day in early today on expectations for a surge in fuel demand, particularly in the United States and Europe and China later this year. At the same time, major producers are maintaining supply discipline. Brent crude futures were up 49 cents at $71.84 a barrel, the highest since September 2019. The international benchmark gained 1.6% on Wednesday. U.S. West Texas Intermediate crude futures rose 44 cents to $69.27 a barrel. Prices earlier rose to as much as $69.32, the most since October 2018, after gaining 1.5% in the previous session. The consensus among market forecasters, including the Organization of the Petroleum Exporting Countries and its allies, known as OPEC+, is that oil demand will exceed supply in the second half of 2021, which has spurred the recent run in prices. OPEC+ data shows that by the end of the year, oil demand will be 99.8 million barrels per day versus supply of 97.5 million barrels per day. And when we come back after the break, more people to remain unemployed globally this year. This and more will come your way after the break. This is Business Incorporated. The International Labour Organization says at least 220 million people are expected to remain unemployed globally this year, well above pre-pandemic levels, with a weak labour market recovery worsening existing inequalities. The United Nations agency forecasts the outlook improving to 205 million unemployed next year, but still well above the 187 million in 2019 before the coronavirus crisis wreaked havoc. According to ILO models, that equates to a global unemployment rate of 6.3% this year, falling to 5.7% next year, but still up on the pre-pandemic rate of 5.4% in 2019.
We expect the employment situation will be worse in low-income countries. High-income countries will close the gaps the fastest thanks to their better access to vaccines and their strong fiscal policy support. An estimated 31 million working people are now classified as extremely poor, living on less than the international poverty line of $1.90 per day, as defined by the United Nations. Let me put it in another way. 5 years of progress in reducing working poverty have been wiped out by this crisis.
Okay, first one is Laurent Siro from...
And global food prices extended their rally to the highest in almost a decade, heightening concerns as economies struggle to exit the COVID-19 crisis. A United Nations gauge of world food costs climbed for a 12th straight month in May, its longest stretch in a decade. Higher food costs can accelerate broader inflation, complicating central banks' efforts to provide more stimulus. The FAO says the pain could be particularly pronounced in some of the poorest import-dependent nations, which have limited purchasing power and social safety nets as they grapple with the pandemic. And on commodities market, today we are looking at cashew. The global demand for cashew is growing this year. Analysts expect cashew to take over 29% of the global nut market. As cheering as the news might be, South Korea-based Trade Market Intelligence's report expressed fear that producers would not be able to meet world demand. At present, Europe is the largest importer of cashew kernels in the world, accounting for about 40% global imports. Well, let's look at the cashew market with Lawrence Mercy, financial analyst with Financial Derivatives Company. Hello, Lawrence. Good afternoon.
Good afternoon. Thank you for having me.
Good to have you. Well, the fourth largest exporters of cashew nuts are North and South American countries, with Canada leading with a pack of about with 12.45% of global export shares. However, the producers, talking about Mali and Madagascar, are not among the top 10 in terms of exports. What could be the reason for this contrast between production and exports?
This is highly attributable to, first, the fact that the top 10 the top 10 exporting countries are also highly involved as the top 10 importing countries. So this could imply that they have extensive research into modifying and producing improved varieties of cashew. This now also translates to the fact that they have global best practices in pre and post-production and processing activities, which makes their own cashew internationally competitive. That is, it meets the standards. However, looking on the from the perspective of the South American producers such as Brazil, we can say that they are trying to satisfy local demand more, which accounts for the fact accounts to why they do not have a share as one of the highest exporters. And lastly, looking at the African producers, this is highly due to the fact that they experience a lot of loss, especially in terms of storage and transportation, because cashew has a low shelf life. So these three factors combined can account for why the highest producers are not amongst the highest exporters.
Now, Ivory Coast has been successful in its cashew story and is a net exporter of the commodity. The country produces about 792,000 metric tons and earns about $1.4 million in exports. However, Nigeria is a net importer, producing a mega 120,000 metric tons and earns just $6.8 billion in exports. What lessons can Nigeria learn from the Ivory Coast cashew fruits success story?
Well, the Ivory Coast has continuing stakeholder engagement with organizations and multinationals to improve its processing ability. This allows it to have the capacity to export more cashew to developed countries, and it also allows them to meet their own food and safety standards. Also, they also have trainings for foreign input regulations for their workers, so they know how best to go about their production of cashew to meet foreign input regulations. So these two things that the Ivory Coast does is where Nigeria is lacking behind, because there is low government participation in the sector despite the many initiatives that have been brought up. There is also a low domestic demand for cashew within the country. The middlemen in Nigeria in the trade value chain also pay lower prices, or they pay prices that they want to pay rather than market prices. This discourages farmers. Also, in terms of farming, there is a lot of smallholder farmer segments as against to large commercial farming of cashew. So these factors are where Nigeria is lacking behind, and they fail to meet up with what is required to meet up with the Ivory Coast in terms of their production and exportation. And lastly, Nigeria doesn't process any actually of its cashew production. It just sells it in its raw state. So there's no improvement and value added. And this is where Ivory Coast also has an edge over Nigeria. And these are the things Nigeria can learn and improve on from the Ivory Coast.
All right, so it's a case of Nigeria improving on its value chain there in the cashew market. Okay, thank you very much, Lawrence, for your time this afternoon. And South Africa is seeking additional electricity from private contractors as the government moves to address long-standing power outages. The government has asked the companies it previously contracted to supply electricity from privately owned plants if they can sell more. The latest program is designed to run for 3 years and may benefit renewable energy plants that already won the right to supply electricity. The amount of power to be purchased is yet to be determined. South Africa has been hit by intermittent power outages for more than a decade because the state power utility Eskom can't meet demand. The government this year tendered for 2,000 megawatts of power from any technology to be delivered by August next year and plans additional tenders for electricity produced from the sun, wind, and natural gas. And that's a wrap on the program. Thank you for watching.